Hey, welcome to the Guaranteed Retirement Guys show. So today we're going to be talking about how annuities are taxed. Okay, so how are annuities taxed, right? I get this question all the time because people come to me with all different types of accounts. Some are qualified, some are not qualified. Some are just straight cash, either from the bank account or from a brokerage account. So let's start with that one first, okay? If we're looking at, maybe I got $500,000 in a brokerage account or in a non-qualified savings account. And when we say non-qualified, it just means that it's not subject to an IRS tax code law like a 401k or an IRA or 403b, any of those tax-deferred pension programs, any of those tax-deferred retirement accounts. They're subject to whatever the rules and restrictions that the IRS gives them. So with a non-qualified account, however, I might fund an annuity with, let's say, $500,000, okay? And so people ask, well, how do I get taxed on that? Well, if you fund a fixed index, okay, we'll just look at that for instance, fixed index annuity, you earn whatever the index is earning. So if it's tied to an S&P 500 index and that index is earning you, 7-8% a year, then your account, of course, grows tax deferred, even if it's a non-qualified account, okay? So it's very similar to maybe a 401k or an IRA. Those grow tax deferred. It's just a little different when it comes out later on, okay? So what happens is maybe you're earning 6 or 7%, maybe one year you earn nothing, and then another year you earn 10%, and so on. Let's say you have that account grow for 10 years, okay? And the index is doing its thing. You might have a roll-up rate that's doing its thing, that's affecting your income value. But again, let's just talk about taxes, okay? Let's say over 10 years, your account balance goes from $500,000 to $700,000, okay? So now your account is worth $700,000, okay? So that's your account balance. And then let's say you turn on income. You have a guaranteed income stream. You have a guaranteed income rider that you use for, that you had attached to it so that you could have that guaranteed income later on. So let's say in 10 years, you turn on your income or activate your income rider, however you want to say it. And at this point, your account balance is worth $700,000. But the annuity company, and it really depends on which one you use, they're probably using a much higher value when they're calculating your income payments. So at this point, it might be $50,000. Let's just say it's $50,000 a year for the rest of your life, guaranteed, okay? You turn on the income, you get that first $50,000 check, or most people, they take it monthly, so divided by 12, a little over $4,000 a month is coming in, $4,200 a month roughly. And what's happening is you're taking that money, and since your account, remember, your account has earned $200,000 in interest, right? So the IRS wants its money. And so with a non-qualified account, here's how it works. They will basically, for the first, if you're taking $50,000 out a year and you've earned $200,000 in interest, because remember, your account balance went from $500,000 to $700,000. So you got $200,000 of earnings that the IRS wants to tax you on. So what's going to happen is the first 4 years, because let's say your guaranteed income amount is $50,000 a year. The first 4 years, you're going to be taxed 100%, okay, of that amount. So that's $50,000 coming out every single year. You're going to be taxed 100% of that $50,000 every single year for 4 years. After that, you've basically used up your earnings, right? And so now you're going into your $500,000. And since it's non-qualified, it's usually after-tax money, okay? You've already been taxed on it. So then what happens is over the next 10 years, they pay you back that $500,000. And that is completely tax-free, okay? Pretty nice. So after that, though, so you've taken income for roughly 14 years, okay? You've taken out $50,000 a year for 10 years, tax-free. After you've taken out the $50,000 a year for 4 years, taxable, okay? So you've taken out $700,000 in income, okay, over that period of time. But, you're going to live for another 15, 20 years. And so now you're going to take out another probably $700,000 to $800,000 or more in income. So that is fully taxable. Okay, that's how that works. So you've already used up all the money that you earned, and you've used up all the money that you put in that you didn't pay, that you already paid taxes on, and so you weren't taxed on it again. And then all the money that comes out is just extra. That's part of the contractual amount that the insurance company promises to pay you. And so they just keep on paying it out. And of course, that's way more than what you've earned. And that's more than the money you put in. You've already used it up. And so because of that, it's what we would refer to as a growth. That's true ROI, and that's income that you have not paid taxes on before. And so, of course, it is taxed at regular income tax rates at that point. Okay, so very simple for that formula. With an IRA or a 401k, it's a little different. So with those, they're all tax deferred, right? So the IRS has been so gracious to you. They're saying, hey, we've given you this tax deduction for 30 years. Now it's our turn. So what they do is, typically what we'll do with an annuity is we'll take, let's say, the same $500,000, and we will transfer that. It's sitting in a 401k, okay? And we will transfer it to an IRA. And that IRA is still tax deferred, so it's a 1035 exchange. There's no taxes paid because you're not taking a withdrawal, right? So what happens is that money goes over into the IRA. That IRA now has, instead of bonds or stocks, subject to risk, it now has an annuity inside of it. Okay, so that's the only difference. You've got baskets with a set of rules. Okay, you've got a 401k, an IRA, 403b, 457, TSP, pension. They're all the same. They're all tax deferred. Okay, and whenever we take money out, we just pay regular income taxes. That's just how it goes. Okay, so with an annuity, what you do is you will transfer from your 401k into your IRA, two separate baskets. Okay, same set of rules, both tax deferred. The only difference is this basket over here has an annuity contract that guarantees your income for life, which is awesome. So, and you might take that income for 30 years, which is $1.5 million in income from a $500,000 annuity deferred for 10 years. I would say that's a good guess just from what I've seen. And so not bad, but just remember, you're taking it out of an IRA, right? It's the same as a 401k. The only difference is in this 401k over here, if you take out the $50,000 a year, it's going to run out in 10 years and it's gone. Okay. And you've taken out the income and you were taxed on it just as ordinary income. The only difference is you took that and you placed it over here in this annuity that gives you a guaranteed income amount. But what happens is you turn on that income, and after 5 years, of course, the income just keeps going. It never ends. It just keeps on going. It doesn't matter how long you live. But what doesn't change is the taxes. Instead of you being taxed for 10 years and then your money runs out and there's nothing left in there, you're just taxed forever because you're getting income forever. And so that's how they work. And it's just based off of your current tax bracket. So you might be taking $50,000 a year from this annuity inside this IRA. Okay, so you're taxed as ordinary income. And then, of course, maybe you're taking Social Security income, which if it's over a certain level, they're going to tax a large portion of it as well. Okay, and then you might have a pension. So it just really depends on your tax bracket, and that is what you are taxed on as a whole. Okay, so that's typically how that works when you're looking at a qualified plan versus a non-qualified plan. So I hope that helps. Again, I'm not a tax professional. Obviously, you got to talk to your accountant, but I know kind of a high overview of everything, but I still recommend you chat with your accountant because your situation is unique. But I set these annuities up for anyone. I mean, if it's qualified money, great. We transfer typically into an IRA. Now, on the flip side, if it's a Roth account, a Roth 401k or a Roth IRA or whatever it is, if it's Roth, then we just transfer to a Roth annuity, right? A Roth IRA and with an annuity inside of it. The only difference now is that income is guaranteed forever, just like any other annuity, but it's tax-free. Pretty nice. So in that instance, you're not paying taxes, which is awesome. So, and if you're looking to avoid taxes, we can do what's called a Roth conversion. Again, talk to your accountant, because it will affect things such as Medicare Part B premiums. And obviously you have to pay taxes because if you're converting over, then you either do one big conversion, which is huge, and could cost you a lot of money in taxes, or you can do it over time. And there are certain annuity companies that will allow it and will not allow it. And so I typically, when I do talk with clients and they want to do that, then we will look at the highest paying annuity companies that will also allow for Roth conversions. Okay, so that will allow you to have that guaranteed income as well as have it all tax-free. So pretty nice. Anyways, if you want information on that, give me a holler. I can look at your situation and we can look at the numbers together. If you want me to talk to your accountant, I'd be happy to chat with them as well. So hope this was helpful. Until next time, at the same time. We'll see you next time.